Okay, so here we are at part 2 of the bank reconciliation introduction, and as you will remember that we went through how both the business and the bank maintain separate records of the business's holdings with the bank, that the cash kept by the bank is owed back to the business by the bank, so the business is regarded as the bank's liability in the bank's records, and that record is the bank statement. So the bank will issue a bank statement to the business, and that bank statement communicates the bank's opinions regarding the cash held by it on behalf of the business. The business itself has their own records that it maintains on cash received and cash paid through the cash receipts journal, cash payments journal, and ultimately those journals will update the business's own bank account in their own ledger. So we've established that the bank reconciliation process is a method of control, and it's used as a method of control by the business because of those records maintained by the bank. They are viewed as independent records, and as such, it's necessary for the business to use those records as an opportunity to establish the exact amount held by the business with the bank. And the reason why a reconciliation has to occur is because often these two sets of records will not agree. So I'm going to highlight for you what that process actually involves in this next slide. And this basically is like a little mini introduction into the prac. So when we're doing an exercise whereby we are reconciling the business's records with the bank's records, we sit down with the business's records in the form of the cash receipts journal and cash payments journal. And we also sit down with the bank's records, the bank statement that's sent to the business. Remember, this bank statement communicates the bank's point of view with regards to the business's cash holdings. So what do we do? The first step, therefore, is to compare the two sets of records. And we do that by looking first at the cash receipts journal, knowing that the cash receipts journal has a list of all of the amounts received by the bank, by the business during the month, and those individual amounts in the bank column represent deposits made into the business's bank account. So those deposits are compared with the bank's records. Do they appear in the bank statement? Does each individual deposit appear in the bank statement? If they do, they are ticked in both records to verify that yes, the amounts agree and they appear in the bank's records and in the business's records. If there is an amount in the business's cash receipts journal that does not appear in the bank records, then it is circled in the business's records. And the business needs to investigate why it is that that amount does not appear in the bank's records. And often these records, the amount circled in the cash receipts journal representing a deposit that doesn't appear in the bank statement is because it'll be one of the last deposits made in the month into the bank. Bank statements are often issued for the end of the month, but they are produced before the actual end of the last day of the month. And so if there is a deposit made on the very last day, that deposit may not have been recorded in that month's bank statement, but will definitely or should definitely appear in the next month's bank statement. So those items are circled if they do not appear in the bank statement. And conversely, if there are amounts in the bank statement that do not appear in the cash receipts journal, again, those amounts would be circled. Now, what kind of amounts would be circled? They'd be amounts like perhaps interest that the business has received for holding cash with the bank. That amount won't be known until this checking process. And likewise then, the cash payments journal is compared with the bank's records. Remember, the cash payments journal has a record of all the checks written by the business, and those checks their check numbers and the amounts are checked against the business's records of checks that have been cleared by them from our account, and they are ticked. So where the check numbers and the check amounts agree, they are ticked in the bank's records and in the business's records. If there are any checks that do not appear in the bank statement, then they are circled in the cash payments journal. If there are any payments made out of the business's account that have been recorded by the bank, but the business was not aware of them, they would be circled in the bank statement as well. So this checking process occurs of ticking and circling. Okay, so then any information that appears in the bank statement which the business was previously unaware of needs to move, all that information needs to be entered into the business's records. So if they represent a receipt of cash, they will be moved into the cash receipts journal. If they represent a payment of cash out of the business's account, then the cash payments journal is going to be updated with that information. So you can see that in a sense the bank statement represents the business's and another source document for the business. This is a source of information, verifiable information that's produced by the bank, whereby we can use that information to update our journals. Now, if there's any information that appears in the business's records, which the bank is unaware of, the business just can't go into that bank statement and make changes because this is an independent record. You can't go, there's no point in doing that anyway. So those circled items in the cash receipts journal and cash payments journal, remember they are circled because they didn't appear in the bank statement. They are the items that the business uses to produce this bank reconciliation statement. So let's have a look at what one of these statements looks like, keeping in mind that all of the information is coming from these two sets of records here. So here we go. Before we do move into looking at bank reconciliation statement, make sure that you look through this definition of what the bank reconciliation statement is. And it's basically the process whereby a business will compare the business's records with the bank's records, and if there are any outstanding amounts that appear in the bank statement that need to be taken into consideration by the business, then they will be used to update the business's records in either the cash receipts, cash payments journal. Okay, so let's have a look at an example of a bank reconciliation statement. So like most statements, it starts with the business name, identify the statement and provide a date. And you'll notice that it's as at because it means that at the end of the month, this is the bank reconciliation statement for that month. So we start off with here a figure that has come from the bank statement. It is the last balance in the bank statement. And in this case, it's $10,010. $10,000.10. And it comes from the bank statement because we want to know, well, the bank thinks we've got $10,010. When we completed our bank account, that's not what we have. We have a completely different figure. So we need to work out why they are still not in agreement. Now, it's a credit balance as per bank statement. Now, remember, it's as per the bank statement and the bank looks upon the business as a liability. So because this is a credit balance, from the business's point of view, that means that's how much the bank thinks we've got in the bank. Does not represent an overdraft. If that was a debit balance, then this would be an overdraft and it would change the way we proceed from this point. But because this represents how much money we've got in the bank, we then add to it any deposits that the business made that the bank has yet to record. And in this example, that was $950. So we've recorded that $950 here. We're going to increase that balance. Remember, this is an amount that the bank was not aware of. It will record that $950 hopefully in the bank statement, in the next bank statement. So we should be moving closer to an agreement between the bank's records and the business's records here. So where did I get that $950 from? Well, that was a circled item in the cash receipts journal. We knew about it. The bank doesn't know about it yet. Okay. What else was the bank unaware of? Well, they were also unaware of unpresented checks. These are checks that the business has recorded. We've made them out. They've been sent out to suppliers. These represents amounts that have been paid by the bank, by the business. But these people who we've sent these checks to haven't presented those checks to the bank. So our bank has not cleared this money out of our account. But this money has been paid in the sense that we have sent out checks for these amounts. So there are two checks that have yet to be presented, and they both amount to $660. So when we take it away from the previous balance, we end up with a figure of $10,465.10. But I'll come back to that. Remember, these checks here, these checks represent circled checks from the cash payments journal. These are checks that the bank did not know about. So going back to that final balance here, when we look at this final balance, when we determine it in the bank reconciliation statement, you should check with the bank account in the ledger. That should be the balance that we have. And we would call it debit balance as per bank account. Now, if it's a credit balance as per bank account, you will be aware of a change in the balance here, and you would write credit balance. But it's a debit balance in this case of the bank account, and you know that this is correct, that we've done this correctly because it agrees with the balance in the bank account. And that's your introduction to the bank reconciliation statement.